All right, we're here today with Cory Williams. Cory, welcome to the studio today. How are you doing?
Great, Devin. Thanks for having me. Appreciate it.
Yeah, it's so good to have you. As we've put together the guest list for this podcast, you were actually one of the first names that came to mind as an individual that can give some absolute value to our listeners. So thank you for being here.
I appreciate that very much.
Yeah. Today's conversation is about a goal-driven tool called a reverse mortgage, or a HECM. And I really want to emphasize this idea, and we'll come back to it over and over and over throughout this episode. But a goal-driven financial tool can be extremely, extremely powerful. In the financial services world, there's a lot of products out there, whether they be investment products, fixed income products, annuities, life insurances. There's a lot of products. However, the best use of a tool in a financial plan is one that it has a goal in mind to solve. You're not getting something or implementing something or buying something because it has bells and whistles. You're implementing something into your financial plan because it solves a problem or fills a goal. Is that right?
Exactly. And in fact, the whole reason financial planners are starting to really like reverse mortgages is because it talks more to goals and strategies, where in the past it didn't do that as much. And it's now being a tool that we can take across an entire portfolio and find ways that we can augment income and maybe achieve a little bit more peace in a pretty tumultuous time of life right now.
Right. So in today's episode, I really feel like our listeners could value from seeing a reverse mortgage from a different perspective, and even having you pull out a couple of scenarios and situations that they might actually relate to, where they might finish listening to this episode and thinking, wow, that was for me. This could be a great tool to help me solve a problem that maybe I didn't even fully realize that I had. So before we get into some of the specific situations and details and what that looks like, can you kind of give us a broad view of a few different ways and strategies that a reverse mortgage can be used inside of a financial plan for someone that's approaching retirement or into retirement to help them find some additional stability or value or benefit in retirement?
Yeah, so reverse mortgages now are, in fact, a few years ago, my company, which had several financial advisors in it, loan officers, and I never allowed them to do these things because they were so simple. They were almost too simple. They didn't really fit for lots of different kinds of scenarios. In fact, they were just for the one person who might have been desperate and may have been about to lose their home. My parents were the reasons I even ever considered looking into one of these, because their financial planner knew secrets about it that I had no idea about. And so when we dug in and looked at the numbers and we started asking about what my parents were trying to achieve with their financial planner, I had a whole new world open up to me. And I recognized really quickly that this wasn't about people who were desperate, trying to protect themselves from losing a home, or they didn't have enough income to continue to make payments on their home. It was actually a tool I was seeing that could be utilized with a person who was a multimillionaire, who had multiple properties owned free and clear. That was the first one that I went, wow, are you kidding me? There's actually something that you can do with a reverse mortgage for those kinds of people. My parents owned their home free and clear. A number of our clients own their home free and clear. Why would you want a reverse mortgage for that? We can talk about that later. There are those who have hardly a dime to their names. And it may make sense on paper, but it doesn't always make sense even for them to align with the goals or what they're trying to accomplish. It's not always a great thing for every client, even when it makes sense on paper. And so in my experience, we've worked with all kinds of clients where they've got a lot of income, a tiny bit of income, they're approaching retirement, they're looking at insurance strategies, they're looking at 401ks, they're looking at their stock portfolio, and all we're doing is we're adding one more piece or one more idea that they could consider, no matter what their asset and income level is.
Mm-hmm. I appreciate that. And I appreciate you expanding the idea of a reverse mortgage being usable or beneficial across many different demographics. Because I agree with you. My original belief in what a reverse mortgage was used for was that individual that didn't have any other income sources or assets, and they needed to leverage the large equity within their home. That was the only option. That or sell their home and move somewhere else, right? Downsize. And so you sharing with me that it's not just those people that this is their last option, but this is just one option for the millionaire or the individual who has plenty of income from other places. This is another tool to improve their financial situation and give them a leg up on, risk reduction or an additional income stream or delaying their Social Security or whatnot. So there's the demographics that this is actually used for is a lot broader than it used to be.
That's exactly right. What's fun about these is I'm a numbers guy. I love financial planning. I obsess about every penny. I have since I was young. I grew up with a banker father. And so things have to make sense to me on the balance sheet or on the financial and the budget. And if they don't, I just dismiss it or I've got to dig in and look at it closer. It's amazing how much fun these have become in discussions with sophisticated clients. I've been in discussions with a client we did one of these for in California who was a PhD in mathematics. The amount of time we spent looking at all the ways he could utilize this was a lot of fun. And then there's those who really don't care. It's just, I don't know and I don't want to worry about it. Financial planner, my adult children, attorney, anybody, just help me find a way to survive. And so if you want to dig deep, you can dig deep. If you want to keep it high level, then you just align with a good financial advisor who can help you just look at your goals and see if it accomplishes the goal, nothing more.
Great. You had mentioned previously a story about potentially your parents. And that was one of the first times that you really dug into what a reverse mortgage could do and the value there that was driving the goals for your parents. Would you mind taking a few minutes and kind of explaining this experience that got you as a mortgage professional, got deeper into the value, the goal-driven value of a reverse mortgage?
Yeah, I think it helps a lot of people understand a little bit more who I am, because when I explain it, it actually becomes a little more believable why I would look at a reverse mortgage. I mean, I started Springwater Capital over a decade ago with a partner. We actually built software. I won't get into that. And we started a large lending company. And I personally never did mortgages. It wasn't my thing. Mine was to provide operational platform for everybody else to do their business. And so mine was about finding how to perfect operations. So why in the world would a guy like me start personally diving into a reverse mortgage? And it was simply because my father called me, and he was a little bit in a panic in 2008. The market shifted, and we weren't really clear about what the future would look like. And so if you imagine a bank CEO who never let his people do reverse mortgages just because he didn't want to take the time to understand them, and a guy like me who had over 400 employees and never allowed it as well because I didn't really want to understand them. I think a lot of people are in that boat. They look online and go, yeah, I've heard this or that. And it's overwhelming because it's such an emotional thing. We're talking about for some people, it's their only asset. And so when my parents, who own their home free and clear, are saying, we need to find additional sources for future income or emergencies, let's put our home on the line because our financial advisor is suggesting it might be the way to go. You can imagine that a banker and a guy like me are going, I can't believe we're here. So it took me about at least 3 or 4 months because nothing's available online really. They talk about, you can remove your mortgage payment and live a happy life. Well,
what does that mean?
What does that mean? And in fact, that sounds like it's just a scam. Remove my payment. A lot of people don't want to remove their payment. They want to keep paying. They just want to be able to know that they have the cash flow they need. So I had to go in and create all kinds of complex spreadsheets for a guy like myself and my father to be able to understand how this would affect their estate, how this would really accomplish their goals, where the risks were, and in the end, if they were to pass away or my dad passed away, what would happen to mom? Would she potentially lose the home? These were big questions for us, and it was an enlightening experience. So Devin, when I finally saw how this all worked, the light bulb went on and I thought, okay, we've got something here, and there are far more people who need to understand what these are. So I took it upon myself and we created another division of the company. And that's what I started putting a lot of focus in. But it's not my primary and only thing that I do at Springwater, but I take them extremely serious because of the complexity of the discussions.
Mm-hmm. So if you don't mind me sharing or mind me asking, with your father, it sounds like he was coming from a very educated background, a banker you had mentioned, right?
Yeah.
So he was very much into the numbers, as were you. How did that situation turn out? Did he end up doing a reverse mortgage? Did he end up finding the goals that he was seeking to find? Yeah.
So theirs was the unusual circumstance that we never knew a reverse mortgage was for. Actually, I think years prior to that, I don't think this method existed or this option. It was if you have a current mortgage with a balance and you no longer want a payment, you get a reverse mortgage, you refinance the existing, and now you've got a reverse, almost the same balance as before, but now you don't make a payment if you don't want to. Mm-hmm. Great, I've got some cash flow. So why in the world would somebody who didn't have a mortgage payment want to even consider this? And that was the discovery that was so great, and why I mentioned before why there are people who are extremely wealthy and all the way down to almost nothing and in between that could utilize the way my parents did it. In their case, they use what's called the reverse mortgage line of credit feature. And that can be a little complicated, and maybe for another discussion where we go a little deeper. But in essence, you take the equity of your home, and instead of borrowing against the home up front, you're putting in place a home equity line. Very similar to the traditional one you might see at a bank, but very different actually under the surface. So you have the great option of being able to draw from it and not make a payment back. You know, if somebody's in a position where they need to draw on their line in retirement age, they're not really in a position to be paying it back, right? That seems like a last resort. And it used to be that every financial planner would say, that I knew in the past and historically would say, we used to put these in place with most of our clients just so they had a backup. Okay, so if I give you, Devin, for your clients an option where you still have that to draw from, a reverse mortgage line of credit or a line of credit, and if they do have to draw on it, they don't have to make a payment if they don't want to. However, what happens if the markets crash? Well, typical home equity lines, sometimes they get frozen by the banks or they get reduced. They can modify it and do all kinds of things. In a reverse mortgage, it's until you die or sell that home, and it increases at a significant rate. That's the part that's a little bit cool.
Can you say that one more time, high level? A home equity line that increases?
Yeah. So
how does that work?
This is the one that confuses people at first. But let's say you started out. I'll give you an example. My folks started out with a $270,000 line of credit, we'll say. And in a reverse mortgage, what's even crazier is that for them, the highest rate that I could have offered them was in their best interest. What? Yeah, normally you want the lowest rate, right? This was the other surprising fact. Well, a line of credit feature in a reverse mortgage grows or increases in it's basically an increase in the access to the full equity of the home. And it increases at the same rate as the rate is on the balance. And so in their case, they had no balance up front, right? They owned the home. So every year, and they wanted the highest rate available, we were able to get them just over 6% of the time when the rates were down in the 3s and 4s. So that's because now their line of credit at the end of year 1 take 6% compounding on a monthly basis, and you've got a significant amount of money at the end of the year that's added on to that available credit. Not only that, but that's non-taxable. So to explain a different scenario, a person might have a $100,000 mortgage balance. And let's say they've got a $500,000 home. And today we can offer them, let's for easy speak, $200,000 line of or loan amount. So their loan's worth $500,000. FHA says you're eligible for $200,000. We have to pay off the existing mortgage of $100,000. What do we do with the remaining $100,000? And what do we do with the $300,000? That's always the question. Well, the $300,000 is just set aside as your equity. It's not part of the loan, just like any loan.
It's not accessible,
right?
But it's just home equity.
It's if you sold the home tomorrow, the balance was $100,000, you'd have $400,000, right? In this case, their loan amount, or the eligible loan amount, might have been $200,000. We pay it off, so you have got a $100,000 line of credit. That $100,000 is going to increase on a compounded monthly rate of whatever your loan rate is. And so if that's 5%, you're going to have a little more than $105,000 at the end of year one. If you keep compounding that and it's not taxed, it's a significant growth of of additional cash that you could access from an asset that is otherwise really not an asset when you're living in it, is it?
It's not. It's there as a functional tool. You live in it. More of an expense maybe because you have utilities and stuff.
Yeah. So this was what my father and I had to go back and forth about, because I said to him, your home is worth X number of thousands of dollars, several $100,000. I said, but that's really not an asset, Dad. Who's that asset for? Well, us. I said, well, only if you sell it, but you've got to replace that with something else. You're going to live in a tent. So I started to realize these homes that they own free and clear, it's great and all. It sounds cool to have it paid off, but at that age, it's more of a liability. It's a safety play. It's where you are safe. It's where your children come to visit you, and you need a place to stay. But it still costs property taxes, insurance, maintenance, and all these things. When we started to look at it that way, we realized, maybe what if we converted this actual asset that's really a deferred asset until we die into an asset that we can use while we're alive? How would that change the game? And for my parents, and for actually one of the biggest things I've seen, Devin, with women in these conversations is they are so concerned, which of course they are, about how they are going to transfer that estate to their children. And I say, well, would you rather wait 20 years until you die, or would you rather access some of it now, and if you choose, disperse some of it now and watch them get the benefit from it? That actually changes our mindset as well when we look at it that way. Look at this now as a living benefit.
Well, on this topic, I wanted to ask, that was kind of my next question, is how does this affect children and heirs? Because in the very traditional way that we think about using our home as an asset or as an inheritable asset, we think of, just like you mentioned to your dad, well, we can use this when you die as an asset that doesn't really change the family's finances until you're no longer living, and now either one of the children is living in the home or your children are going to sell it and disperse it 3 or 4 or 5 ways, and at that point then it turns into a tangible, countable asset that's going somewhere else. So I would imagine that there's several different ways on how this asset can be used now, both living and as you pass, as a maybe leverageable asset. Is that right? So let's kind of talk through that. So you'd mentioned briefly that while they are still living, they can access some of that to disperse.
Yes. So we could break this up into several examples if we'd like. So just stop me when I'm saying too many of them, but I'll go back to their example really quick. And this is one of the cooler things. And if people learn to think of these in this manner, they're starting to really get the power behind them. And it's actually the same conversation when I've seen financial advisors who in the past haven't really embraced or known much about them go, whoa, okay, this is the way we should think about these. So imagine them now, they've got $300,000 or so in their line of credit and available. And we could say this for anybody even has just 10,000 or whatever, but in their case, it was 300. I had a family member who was not affording rent, and my folks would shell out money here and there. And we always talked about, well, wouldn't it be nice if we controlled that home that she lived in and controlled the rents? I said, hey, Dad, why don't we, the home she's living in, it's actually for sale for $190,000. It's not listed, but the landlord has always said you could offer that. I said, for $190,000. So why don't we take some of that line of credit, purchase that home? Well, that's debt. Well, we've got an offsetting asset that is also increasing in value because it's real estate. It's also cash flowing because you're getting rent from it. If she has to leave that home, it continues to rent, or we sell it for however it's increased in value. Gain. Well, what if she needs that forgiven rent payment 1 month? Before, you were pulling it out of another source of your retirement, which always made you nervous. Instead, here we're saying, you know what? Let's pull this out early from the children's estate and almost advance it to her.
I like where you're going with this.
So now I'm advancing my children another asset out of my current asset when you talk about leverage. So now we've got something that's increasing in value, and it's getting an offsetting payment to keep the interest paid down. It also, rents can increase. So we may have a cash flowing, at some point that would be paid off, in fact, again, and now it's just a cash flow. If my parents had died, we now had their home. It may have already been paid off again with the line of credit they had borrowed from to buy the other. And now we've got 2 properties we could rent. Now, you normally would never connect that thought process with something like a reverse mortgage. That's where the power becomes. Now, in the end, we didn't end up needing to do that, but that's the idea.
I hear a couple things as you share this example. I see, number one, as a parent, it's always nice when you can grow your inheritable estate for your children. However, one downside to an inheritance that I've always seen is an inheritance oftentimes comes many years down the road and past any current trials that your children might have benefited by having access to some of those funds to help them through their challenges. You had mentioned maybe, a sibling that was struggling to pay rent. That might be a sibling that would be really benefited by having a down payment for a home or being able to pay off some college debt. I mean, you can think of all of these examples that we all, and trials that we all go through that may, at the discretion of the parents, of course, may be better dispersed now throughout life in those experiences, as opposed to when that sibling or that child is 40 or 50 years old. The hardest times of their life are already behind them, and now, great, they get a few $100,000 for an inheritance, but wow, I sure could have used that 20 years ago. So I love what you're saying about how the equity line inside of a reverse mortgage, potentially at the parent's discretion, of course, can be used to continue to parent, imagine that, and help raise their families through those challenges.
Yeah. Think of one more example. We could talk about as many as you like, but another way to think about this. So my dad actually, he had to draw about $20,000 not too long after the start of that. And it was to buy a car that they needed. Actually, I think it was for us. I think it was for a granddaughter. They were trying to help her and my daughter get ahead, and so they drew that money out to help. They were going to get that paid back. They knew that. Well, so here we have got this $20,000 loan balance, and I thought, my dad was getting a growth of about 6% tax-free on the line of credit, but that means he's also paying 6% or so on the actual balance. I happen to have $20,000 sitting in a money market account that was getting like 1 point something percent. And of course, I'd get a little tax notice at the end of the year that thank you for making, your extra $200. Here's and you got to pay taxes. I said, Dad, why don't I take that $20,000 out of my account? I'll pay down your mortgage balance. Effectively, we've just paid down the family's estate that was accruing interest on that $20,000 at 6%. I'm using my $20,000 that was sitting there at 1.5% being taxed on its interest. And I've effectively, in the long run, just also, and by the way, that $20,000 I put down is now growing at 6% now too. Now, once I take it back, we're not really left with the $20,000 plus that growth, but it paid down that balance in the front side, which meant long run, you know how things compound in mortgages. That was a big savings, a big win for me. Again, these are the kinds of things, if you think about how this works, but it's until you actually visually see how those numbers are, sometimes it's very confusing, Devin.
That's okay. That's why you're here, right? That's why the value of sitting down with a consultant like yourself and running those numbers, running those goal-driven scenarios can be so powerful. But continuing on this conversation of the benefit for the children and the heirs, let's kind of take the living benefit concept and put that aside. Into the future, once mom or dad are well into their aged years and they're about to pass away, and you have this growing asset and equity, but you also have this growing equity line. Is there any potentiality of once mom and dad they're about to pass away that the equity line would be greater than the actual value of the house? and how do you navigate that if so?
So this is one of the coolest things I ever saw. It's not as easy to accomplish that scenario since FHA changed their lending limits a little bit 2 years ago. However, at the rate my folks, their line of credit is growing, by the time mom is 82, that line of credit will probably be over $800,000 in size. Remember, it started at about $270,000. Well, their home up there where they live has never really increased in value. It's kind of a retired area. It's up north in the state. And I would bet that at that age, that home would be worth less than the line of credit would be worth. In that circumstance, we had an upfront discussion with the family that said, now we can never guess exactly when mom and dad are going to pass. And once they do pass, the line of credit is voided, just like a credit card. So we can only still now get as the heirs whatever the value of that home minus the payoff of the loan. But in their case, the payoff would be zero. The home may have accumulated or appreciated to $700,000. So we sell it, we get our $700,000 minus fees to realtors, and we split it. In this case, we could foresee that it was possible for their line of credit to be over $800,000 at that year. So we said, how do we go about this when we get to there? And mom is perhaps alone at home, and maybe she wants to live with somebody. The home's too big for her. She needs to move to an assisted living. That's still her money. It's not the kid's money. But how do we make sure she gets the most value out of the estate? And how do we make sure that the kids have the money to help get her to the end of her life comfortably? So we thought, well, there might be a point then where if mom or dad, whoever is living in the home, is needing to move out and move into assisted living or with the kids, we could either sell the home if that line of credit wasn't great and get the equity out and put it in their trust, and we utilize it for their benefit until they pass away and it's dispersed just like it would in a normal circumstance. If the line of credit exceeds it, though, Devin, we can pull that all out. These loans are non-recourse, which means even if the home balance or the mortgage balance is higher than its value, those parents can walk out of there. They could pull the $800,000 line of credit, stick it in the trust, some other investment, whatever they want, hand the keys to the lender and say, thank you for the benefit. The home's worth $700,000, but now there's an $800,000 balance. The family has essentially come way ahead than going through trying to sell that home and liquidate everything in it. And that's what I think you're talking about, right?
Right, it is.
So,
yeah. So, and I asked that question because I think I love this conversation because it seems to me as a financial advisor, there's so much flexibility in a reverse. So that's why I wanted to kind of point that out. However, we might have the naysayer or doubter out there that says, well, yeah, but what's the cost of that flexibility? What are you really paying for to maintain or have flexibility in a growing equity line, flexibility in accessible use of this growing equity line? Or what are you paying to have no payments? So maybe we'll kind of go there now as we talk about a reverse. What are the risks that individuals are taking when they open a reverse mortgage? What are the expenses? What can they ahead of time kind of expect through that process?
Okay, so let's stay on track on two things here. One is the risk, and then the second one is the cost. I don't really align or put those in the same bucket in reverse. And I'll explain that in a moment. The risks are the same if you have a traditional mortgage, and almost the same even if you don't have any mortgage and have paid it off. There are 4 requirements for a reverse mortgage. If you don't follow these requirements, you are at risk of default. So what are those? 1, you have to continue to pay property taxes. And in the past, this was where reverse mortgages as a reputation got in some big trouble because they used to not qualify people based on income. So let's say you brought your mother to me and she was desperate and she's making $1,200 a month in Social Security income and her mortgage was $400 and barely had enough to survive. Well, in the past, I would have just said, hey, yeah, great, take the mortgage. We just saved you that payment. But we really didn't look at the fact that she probably can't even pay the property taxes either. We've, as an industry with a fiduciary responsibility of these clients, we actually have, we used to not have those checks and balances in place for income or credit. So people did lose their homes. They couldn't make the tax payment. Was that really the lender's fault? Maybe not, but it was the lender's responsibility to have told them. So that is a fact that did happen.
So let me kind of pause you there just so we're clear with our listeners. So the risk of losing your mortgage is really not paying your property taxes, right? Just like a regular mortgage. So not paying your property taxes, and then the only other scenario where you could lose your mortgage or lose your home is after the final spouse passes away, right? Or if you move out of the home.
Okay. That has to be so the 4 things are pay your property taxes, pay your homeowner's insurance, occupy the home as your primary residence, and maintain the property. Okay. If you can do those 4 things, you're in the clear. And you've got to do all those whether you've got a mortgage or not, don't you?
Right.
Okay. So your next question was the cost. Here, we always come back to what is the goal? Because in the end, I get clients all the time. They'll look around the room. We'll have gone through all these different things. We'll have talked costs. We'll have talked risks. We'll talk to state. And they always look at me again and say, Cory, what do you think we should do? It's amazing that we actually come back to that and they look at me like that. This happens almost every time. They've got a financial planner and because you've got a son or daughter worrying about cost more than anything. They worry about that more than the parents do. The financial planner is also looking at those saying, okay, how's that going to affect the overall portfolio? So the question you mentioned at the beginning, what are the goals? If it achieves the financial goals, and not even always just the financial goal, because these don't always have a huge upside on financial gain. It serves its purpose. It provides additional augmented sources of income, a balance across the portfolio, but it's also about peace of mind. And in fact, more so about peace of mind. So the costs can be a little bit high from the perspective of anybody seeing these for the first time. The biggest one is the upfront mortgage insurance premium. FHA requires it. It's 2% of whatever the value they use on your home. So if it's a $400,000 home, $8,000. That comes right off the top. Is that a big hit? Well, if it was a regular mortgage, you'd be saying, yeah. What are the other costs? Well, a lender could charge an origination fee. A lot of times we never need to do that. There are appraisal fees, title fees, and everything is exactly the same as a traditional mortgage. Lenders have the ability to sometimes help pay those, but they always have to pay that upfront mortgage insurance premium. So let's suppose that the total cost on your deal for your mother, Devin, was $15,000. And we're paying off her mortgage. She's now saving $1,200 a month on a payment. And she has a $50,000 line of credit that's increasing at, say, 5% annually a year, tax-free. And I tell you, her home that's worth $600,000, we're going to take $15,000 out of that value today to achieve that goal. It's not going to cost her personally, but it will come out of the loan proceeds and be part of that balance. How would you look at it?
I would love that, primarily because we're again coming back to the goal-driven solution, right? So if it was my mother and this was her scenario, we look at all the great things that are going to make a significant immediate impact, which just reducing the $1,200 a month payment alone is absolutely worth that. Let me kind of step back from a financial advisor standpoint and step into the child's role. For me as a child, I'm looking at maybe $15,000 that's coming out of the equity of the home, right? I might look at that. I look at it that way and say, sure, $15,000 less is coming out of inheritance of the whole family, but the quality of life and peace of mind for my mother is now completely opened up for her to, for the next 20 years of her life, have some peace of mind knowing that she's living within her means. She has enough cash flow for all of her expenses. She can be a better grandmother, be a better mother. So for sure, if I step back from a financial planner's perspective, and then even as a child, that cost does not seem like a cost anymore because it's properly positioned as just, a short-term expense to accomplish the goal that is much more valuable than that.
I can tell you there's a circumstance where not always, but I encourage them not to do one. So after the goals, I'll say, how long do you intend to live in this home? Now, nobody knows for sure what will happen in their future. But there are those who will say, we absolutely want to live and die in this home. There are those that say, well, we want to live in as long as we can, but we then intend to downsize to a condo. So now we have to discuss in that conversation what the end result will be, what's the net effect to the rollover of their equity into the next home if we use the reverse mortgage, right? Mm-hmm. But if it's a long-term play, and usually that's just beyond 3 to 4 years. In fact, in reverse mortgage and recouping that potential upfront loss of that equity. But if they're going to move anytime in that period, I usually say, is there anything else that we are accomplishing where it doesn't matter? So I'll give you one more example that I've had to use with several people, actually, and clients is, there was one couple that we knew he was going to die within a year, the husband. I was mostly concerned that anybody would feel like we were trying to push them into this before he was dying. But she was the one calling the shots on this. She was the mathematician of the family, in fact, and she wanted protection to make sure she could remain in that home. But she told me right up front, I intend to move and sell this in 3 years. And so immediately I get concerned about that with any client. I think, well, do we want to take that much chunk then? But when we did all the cash flow analysis with her and with her advisor, it was clear that we didn't know with her health if something else might happen within the next 3 years that would cause her to need access to that cash in that time. So would the $15,000 really matter in the long run? Because we were accomplishing even something we absolutely needed to accomplish now.
An extra level of certainty.
Yes.
That would protect against any health concerns on her end.
Yeah. But you're right. Ultimately, I'll always look at the clients, and this is also why I'll invite their adult children to be part of it. And not all of them want all of their adult children. It's their financials, or their finances, their asset, and they don't want to be swayed by children who are only trying to protect the interest of their asset when they die. But there are more children who are more interested in protecting the interest of their parents, I'm finding. Total shift in attitude about getting the estate when they die to, this is an expensive world. And I would rather not have to pull money out of my account when I'm 60 and my parents are 90 to help them, because I'm going to be worried about my own. I'd rather say, I'm glad we set up this reverse long ago. Mom's got a line of credit sitting there. We can pull from that to cover these medical expenses. Or we need to move her into the home. Let's shift this into a trust that can help pay my wife to go get her medical things while she lives with us. It took a lot of burdens off of our shoulders.
So in the traditional sense, I usually think about using this goal-driven tool to accomplish something for those that you're getting the mortgage for. But as I listen to you, I'm kind of starting to have my eyes see a little bit more clearly how the effect, the positive emotional effect, absolutely could trickle down into the next generation, to the children. So now the children, once they properly understand what mom and dad are doing, might take a bit of a burden off of their shoulders.
I bet you've run into this several times, and I'm sure your audience is, some of them may feel the same way. So I remember 2008. Most people do, and the years that followed. A lot of people had a lot of things taken from them. If nothing else, if it wasn't even their money, it was a certainty, it was a confidence that the future was always somewhat consistently moving upward. Well, in this case, I remember being at the beach with my parents and saying, hey, let's go next year, take all the family, because it was always their thing. They built up some little of a nest egg for those kinds of things. My father said, no, absolutely not. Money's tight now. We're on a budget. And I remember going, I can't believe you've worked this long and accomplished so much, only to be saying, we can't go on a vacation with my grandkids, children. So this was before we actually did the reverse. This was before I really understood it. What did I do? I was saying, okay, well then fine. If this is so important to the family, I'll pay for it. Well, that was when it kind of clicked and we had this conversation. And I've had it with many clients actually, where I go, there's a different change in your mindset. I just got off the phone this week with a client of another financial planner. He retires in 4 months. And he said, this is a new feeling. He says, I'm a little bit nervous. It was always upward. And all of a sudden, we don't know what to do or what to think. And we're worried about any dollar we're going to spend, when all our lives we just thought it was going to be great. But now we're starting to really panic. Well, what this can do, Devin, is it kind of gives you a little bit of what's the word? The freedom or the permission to still have a little bit of fun. Even when all the rest of the portfolio may not be behaving exactly like you'd wanted in its returns and its growth, the markets aren't. I go, you've got this asset, and yet it's doing nothing for you today without this instrument.
Right. I like how you say like permission or green light to be able to play a little bit and enjoy a little bit, because it's an asset that's not correlated to the ever fluctuating stock market that can be up and down and up and big down or big up. It's a more consistent level, hard asset that's kind of linked to your primary residence over time.
So you said something, I think before we even started this, and what's the word or the terminology that you use in financial planning? It's the sequence of returns. Well, the idea is to make sure you're drawing when the returns are at their greatest. If the markets are crash and you start drawing while the markets are down, well, you're kind of ruining that trajectory of averages, I guess. I'm not in your position, so you can use that better terminology, but I've been told by you, in fact, years prior and others, that's when, if the portfolio has dropped because of the markets, we do not want to pull from that right now. Let's pull from a different source. And typically that has been the reverse mortgage line of credit. Perhaps you can even tell me why that would be the best solution.
Yeah, having a non-market correlated asset, it's kind of comes back to a bucket approach where you have separate buckets that behave differently. So if you have a market-based account that you're, to supplement your income, you're pulling $25,000 a year from, and in an extended period of time, 1, 2, or 3 years, the market might be down, but you continue, because it's your only bucket, you continue to pull from that asset that's declining in value. It's a double loss, right? Your portfolio is declining in value, but then you're also permanently locking in all of those losses with those shares that you have to sell at a low price. And so the value of having either cash on hand, which we know that's not the best solution because it's being eroded with inflation, whether it's cash on hand or reverse mortgage, or sometimes in a CD or a fixed index annuity, some other asset that is not declining that same period of time, and you use that asset to fill that part of the market that it's down, you can maintain a lot of your market and equity value over the long run because you didn't lock in any negative losses during that 1 or 2 year period of market declines. So in this concept of sequence of returns, and maybe inside of the show notes of this show, I'll insert a little presentation or PDF that explains this. It's a very, very real risk that retirees have that can absolutely be offset by this equity line inside a reverse mortgage. Just like your parents, you don't have to use it. It can sit there and continue to grow. However, the flexibility in future years, if the market declines, and albeit it could be a short period, maybe a 3-month time that the market dips and you don't want to lock in some of those losses because you're using that market account for supplemental income. It might be a 3-month period, a 6-month period. It might be a 2-year period that a reverse mortgage equity line or cash availability could extremely benefit the longevity of your assets because you have accessibility to that asset.
Yes.
So there's a lot of, and so many, probably too many to even talk about on this episode, but there's a lot of circumstances where a reverse mortgage from a goal-driven standpoint makes sense. So for this next few minutes, I'd love to explain a few short scenarios that I've come across with different retirees, and maybe you can respond how you would with a client on how, as a goal-driven tool, a reverse might be a good fit. Does that sound okay?
Perfect.
So let me go here. So here's a scenario. Here's a client that would like to retire, but still has 15 years left on their mortgage. And they've looked at their budget and they've realized we just cannot retire until our home is paid off because that additional mortgage expense every month is too much for us. If someone came to you with that type of concern and wanted to retire sooner than later, how would you approach that?
Well, this is one that comes up all the time, and it's interesting because a lot of people want to feel like they are meeting their obligations of any debt they have. So if I came to you and said, hey, and I advertised, let's remove that mortgage payment, there are people who may still be concerned about that future payment, but who also don't want the feeling of I'm not meeting the obligations of the loan that I have. This was a big deal for a couple that I had, where all she wanted to know, and this is where I'm going with this, is can I still make a payment? So backing up, in this circumstance, if somebody is still making money, and even afterwards when they're not, and that's another scenario we can do, another episode, but they're probably still making income in this scenario. Is that correct? Let's assume they are. Mm-hmm. So why would I do a reverse mortgage now if I'm of age? Well, First of all, remember, a reverse mortgage is simply just a traditional mortgage on steroids, meaning it's exactly the same concept. There's a lien on your property, and you have a choice, which often people don't understand or recognize or know the benefit of. You can make a payment, you can not make a payment. Make a smaller payment, make a larger payment. The huge benefit is once you've set this up, every dollar you pay into the mortgage is an offsetting line of credit dollar. So if they continue to go ahead and pay the mortgage down on their traditional mortgage, that's great. But you still have to qualify on income and credit and other things. So what happens if you say, well, let's wait another few years. We're eligible now, but let's wait 5 years. And you go to try to qualify for a reverse mortgage. And maybe you've just for whatever life reason have accumulated some debts you didn't expect or expenses that came out of nowhere. Well, if we had set up the reverse mortgage in advance and you were making that same payment, the rates are pretty much the exact same right now as the traditional mortgage. They may be off by maybe a quarter or an eighth, but every time you make that payment, let's say it's $2,000 a month, you're getting $2,000 each month in additional line of credit. So 3 years into this, you've paid your loan down just like you did with your traditional, but now let's say 2, 24, 48, you've got potentially $72,000 plus its growth at that 4% or whatever rate you had, compounding tax-free. You go, wow, really? So I've paid my loan down. We're still on track to do that. But now I've got a mortgage I don't have to worry about in 5, 10, whatever years, and I've got an offsetting line of credit. You need to draw it out, draw it out. You want to draw a dollar out, draw a dollar out. You got a child who suddenly is trying to get into their first home and you want to give them a gift. Normally you'd be stuck. You're too worried about trying to accomplish your goals, and so it's very stressful when someone needs that. So that's where I would go with that discussion.
So for this family that wants to retire but still has 15 years left to pay, so they can choose to pay and continue to work. However, if they had a reverse and at any point in time they wanted to just stop paying their mortgage, so it's not paid off, they still have a balance, but they just want to stop paying, how does that work inside of a reverse?
The same thing. You just stop making the payment. It's non-recourse. You can stop making the payment. At that point, of course, that loan balance will just start to kind of increase, right? It's negatively amortizing. You know, Devin, as a financial planner, one of the coolest things I ever saw of one of your peers, so we put the reverse mortgage in place way ahead of when they really absolutely needed it. There was a good reason for it. They actually had another asset, or I can't remember exactly what it was. It was some asset in their portfolio that was only yielding about a 2% net after tax. And there was $120,000 in it. So I said, why don't you watch that asset? Let's switch the traditional to the reverse. She had I believe it was $175,000 balance to start. So she could choose to continue to make a payment or not to make a payment. She also got a little bit of a line of credit. Well, this financial planner said, oh my goodness, the reverse mortgage line of credit hers was growing at 5%. This other 120,000 she has and this other is growing at 2%. So he withdrew all that money and paid down the reverse mortgage by $120,000. Wow. Which gave her an offsetting line of credit of $120,000, now growing at the 4% tax-free compounding monthly. Wow.
Yeah, wow.
So we just shifted things around because you can do that with the reverse mortgage.
Right. So that concept kind of comes back to your ability or desire to kind of look at the numbers and make some economic decisions. Some folks out there might not really have that perspective, but if they're talking with their financial advisor, I feel like it might be a tool that they should bring up with them. Say, hey, do you know how a reverse mortgage would work into this scenario? Is there any scenario where I might be able to improve my retirement situation?
Yes. I think the takeaway today for anybody would be, no matter what you think and what you know, in almost every circumstance, we've been able to find silver lining across the total portfolio strategy for considering one of these. It's a light bulb goes on. Mm-hmm. And it's nice to know, wow, I'm not just limited to only these areas for my retirement. It's just comfort. Whether you do it or not, even if it makes financial sense, is not what's important. To me, if I'm in that age bracket and I'm looking at retirement, I just want to be comforted by the fact that there are ways to solve problems that we maybe can't foresee today. Mm-hmm. So if nothing more, if anybody asks me, is a reverse mortgage good or bad? I say, well, that's a very loaded question. It's after we've discussed, even with your children if you want, with your attorney if you want, your financial planner, it may all look like this is a much better way. But if it doesn't even let you still sleep well at night, then you don't need to do it. But at least you know it's there.
Right. Yeah. And as we opened this episode, you'd mentioned that when you first started looking at reverse mortgage, there wasn't really a lot out there as far as truly educating people on how this can solve problems, right? It was always there as like an option as a product, but not really a lot of benefit training. If we have listeners out there that are just wanting to dive in and learn a little bit more themselves, do you have any resources or places that you think that would be a good place to go to start that?
Probably the best and most unbiased place. I mean, I could send you to my own personal site, whatever, but would be reversemortgage.org. So that's an association in DC. It's in business because of paid membership across the nation and people who adhere to a specific set of guidelines, just like a financial. What's your name of your association in DC?
The RICP or okay. The SEC, yeah.
Well, they've got a great site of information, and it's also a place you can look up. In fact, you'll find that I'm the only individual in the state of Utah and across multiple states that's what you call a CRMP. It's the Certified Reverse Mortgage Professional. It's a much more difficult certification. Does anybody need it? Does it mean that they aren't good at these because they don't have it? Absolutely not. It just means that we have agreed to adhere to a very high standard of ethics. Mm-hmm. And that's where I would send people first.
I appreciate that. And we'll put a link to that in the show notes so they can go out there. Reversemortgage.org.
Yes.
Yeah. One large takeaway that I have from our conversation today is just starting a conversation. Usually when the folks are sitting down with their financial advisor and having an annual review, I think would be a great time for our listeners just to ask their advisor, hey, are you familiar with a reverse mortgage? Do you know how it might fit into my retirement finances? At least asking that question. I know this podcast is for retirees, not financial advisors. If it was, I'd be telling them to read up on it and approach to their clients. But because of the audience that we're speaking to, I think my biggest takeaway is encouraging everyone to at least ask a professional, whether it's their financial advisor or a reverse mortgage specialist like yourself. Just start that conversation, because at the end of the day, the worst case scenario is you can come to the conclusion that it's not a good fit for me. Best case scenario, you might, like you mentioned, find silver lining or maybe a gold lining, because it could significantly fill a space in your retirement plan that you did not really totally understand that you had. So, Cory, I appreciate you showing up today and sharing some of your insight. But before we go, I did want to ask you more of a personal question, because I asked this of all of my guests here on the show. What makes you feel alive and relevant in your life and your family?
Alive anytime there's powder on the slopes and glass on the lake.
Oh, you live in the right state for that.
Yes, I'm a Hebrew boy, and I'm there because I am passionate about those things. Mm-hmm. Now my kids are grown and are leaving the house, and all I think about now is retirement. Ironically, before I was thinking about when are we going to go sledding and have some fun with the kids, and now I'm starting to panic a little bit too about getting my ducks in a row. Uh-huh. Why at age 48 do we start really thinking about that more seriously?
Sure.
But, it's interesting because of all the things I've done career-wise, And this doesn't really relate to a reverse mortgage, but nothing is more enjoyable, and I'm sure you agree, than sitting in the home of a couple looking at retirement planning and talking about their families and their pains and their health and all these different things. And then we kind of roll in these discussions too that they don't really even want to talk about much, but lift a huge burden that they didn't even know was there until they feel it lift. I have absolutely loved that about these.
That's great. So I can see how you might, or you do feel very relevant in the world and your community, because you're showing up and you're providing this wisdom or education or knowledge that is seemingly clearing some uncertainties and adding a level of peace of mind or understanding that, just like you explained with your father, allowing them to live a little bit, have a little bit of a permission slip or green light to enjoy some of the great things that they've done so far.
Yeah.
So again, thank you so much for joining us today. I appreciate you being in studio and providing some value to our listeners. So everyone, we thank you so much for listening, and we will see you next on next week's episode.